Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights. Today, we're going to explore the world of mutual funds and ETFs. These investment vehicles have revolutionized the way individuals and institutions invest in the stock market, providing a diversified portfolio with minimal effort. To start, let's define what mutual funds and ETFs are. A mutual fund is an investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. An exchange-traded fund is similar, but it trades on a stock exchange like individual stocks, allowing for more flexibility and transparency. The concept of mutual funds dates back to the 19th century, but they gained popularity in the mid-20th century as a way for average investors to access the stock market. ETFs, on the other hand, were introduced in the 1990s and have since become a popular alternative to traditional mutual funds. One of the key principles underlying mutual funds and ETFs is diversification. By spreading investments across different asset classes, sectors, and geographic regions, these funds aim to reduce risk and increase potential returns. This concept is rooted in modern portfolio theory, which was developed by economists such as Harry Markowitz and William Sharpe. Another important principle is the efficient market hypothesis, which suggests that financial markets are informationally efficient and that prices reflect all available information. While this theory has its limitations, it provides a foundation for understanding how mutual funds and ETFs operate in the market. Influential thinkers like John Bogle, the founder of Vanguard, have also played a significant role in shaping the mutual fund industry. Bogle's advocacy for low-cost index funds has democratized investing, making it possible for individuals with limited resources to invest in a diversified portfolio. Companies like Vanguard, BlackRock, and State Street Global Advisors offer a range of mutual funds and ETFs that cater to different investment objectives and risk tolerance levels. For instance, the Vanguard 500 Index Fund is one of the largest and most popular mutual funds, tracking the S&P 500 index and providing broad exposure to the U.S. stock market. ETFs, like the SEDRS and P500 ETF Trust, offer similar exposure, but with the added benefit of intraday trading and transparency. These funds have become incredibly popular among investors, with over $6 trillion in assets under management globally. So, how can you apply mutual funds and ETFs to your own investments or business ventures? First, it's essential to define your investment objectives and risk tolerance. Are you saving for retirement, looking for income generation, or aiming for long-term growth? Understanding your goals will help you choose the right funds. A core satellite approach can be particularly effective. This strategy involves allocating a portion of your portfolio to a core fund that provides broad diversification, and then using satellite funds to express specific views or gain exposure to particular sectors or themes. For example, you might have a core allocation to a total stock market index fund and then use smaller allocations to sector-specific ETFs like technology or healthcare. Cost management is another crucial aspect of investing in mutual funds and ETFs. Fees can significantly erode your investment returns over time, so it's essential to choose low-cost funds that align with your objectives. Research has shown that lower-cost funds tend to outperform their higher-cost counterparts over the long term, making cost a key factor in your investment decisions. Tax efficiency is also vital when investing in mutual funds and ETFs. Tax loss harvesting and holding tax-efficient investments in taxable accounts can help minimize tax liabilities and maximize after-tax returns. For instance, tax loss harvesting involves selling securities that have declined in value to offset gains from other investments, reducing your tax liability. In conclusion, mutual funds and ETFs are powerful tools that can help you navigate the world of investing with confidence. By understanding how they work, applying them in a way that's tailored to your goals and risk tolerance, and being mindful of costs and taxes, you can unlock new opportunities for growth and wealth creation. Remember, investing is a long-term game. It's about time in the market, not timing the market. As we wrap up today's episode, I want to leave you with a quote from Warren Buffett. Price is what you pay. Value is what you get. When it comes to mutual funds and ETFs, it's essential to focus on the value they provide, rather than just the price. That's it for today's Business with Louis. Be sure to like, share, and subscribe, and remember, every great business starts with action. Make your next move count.